There are just over 20 minutes left until the closing bell, but today we're looking at how to navigate the private markets with the Yahoo Finance playbook. Lack of liquidity has raised concerns for private investors, but our next guest sees some opportunities ahead. We're joined now by Eric Hirsch, Hamilton Lane co-CEO. Eric, it is good to see you. So maybe just start high level with us, Eric. When you're talking to investors, clients about private markets, what are you telling them, Eric? How do they look?
Well, first of all, happy to be here, so thanks for the opportunity. I think what you're seeing is tremendous amount of flow, particularly from retail investors coming into the private markets. I think what we've all been seeing and hearing for the last couple of years is reality, which is the public markets right now are dominated by a very small number of high-performing stocks, and that is carrying all the indices. Once we get past that, the picture a lot less attractive. If you think about where jobs are being created, where growth is occurring in the economy, it is by and large happening in private companies. And so the way to access that is obviously coming through the private markets, and the performance has been there, the opportunities are there, and that's why we're seeing the flows of capital like we're seeing them.
And what's happening to the valuations there, Eric? Because as you say, in the public markets, yes, they're dominated by a few names, but that means that we have been seeing a lot of records for the major averages in the public markets. But on the private side, there haven't been that many deals, right? There haven't been a lot of exits. So I wonder what that picture looks like.
I think private capital's been a little more patient. And so I think what you're seeing is deal doing is there. It's not at record levels or anything close to it. I think the markets are kind of adjusting to a lot of instability right now. So rate cuts coming, election cycle coming. And I think the result of that is that you've got buyers and sellers kind of squaring off against each other. Questioning is now the time. That's beginning to thaw, and I think the pictures are becoming a little bit more clear. And so we're expecting to see and are beginning to see the volumes picking up. On the valuation levels, I think the story for the public markets is a lot less attractive. You have a tremendous number of unprofitable public companies trading at really high multiples still, and that has not yet sort of flushed out. I think, again, sort of the rise of these sort of big tech businesses are kind of pulling everybody along with them. That's not what we're seeing across the private market segment right now.
One data point I'm curious about, Eric, and I bet you have it, which is, when we talk about the retail investor, your average retail investor, what is their private market allocation, Eric? And has that evolved? Has that changed at all over the last few years?
For the vast majority, the answer is simple. It's zero. They have not really had a good opportunity, good access point, right price structure, right legal structure to access these markets. By and large, it's basically been 50 years of this asset class dominated by institutional investors, and that finally is over. There's now a multitude of products that are attractive, that are more easily available, and the technology changes are coming to make that access point even easier in the form of things like tokenization.
I know you're a big proponent of tokenization, right? And I'm curious if you do see more of that on the private side. Will individual investors, retail investors, still have to have, will they still have to be accredited? Will they still have to have a certain amount to invest, for example? How will all that shake out?
Yeah, I think we think about tokenization more around kind of an access point. So think about sort of the private markets kind of heretofore have really been about writing a check. And no one wants to write checks these days. We want to use something like an Apple Pay. And so I sort of more equate the token world to more of the Apple Pay, just simple ease of use. That is not structurally changing kind of who the investor type is. It's really more kind of meeting the investor where they are, which is you want to operate in a digital passport environment with a digital wallet. You want to make sure that you're sort of tracking things, again, in that more digital way. And so tokens are the way to go about doing that. So I think it's just simple and more of an easier way to transact.
Eric, I want to get you out of here on this. Let's say you're a retail investor, you're listening to this, you're curious, you're thinking, maybe I will shift somewhat from public to private. What do they need to know, Eric, about that? Just in terms of some big picture themes, in terms of duration, time horizon, volatility.
Well, I think it's interesting. I mean, most of the capital that we're talking about for the retail investor is not money that they're going to spend on groceries next week. It's really about capital that people are putting away for retirement. So by definition, it's already long-term capital. And we would say investors should adopt that long-term mindset. So if we look at the institutional world today, on average, about 15 to 20% of their assets are in the private markets, not alternatives, just really the private markets. And so that has served them well. Typical institutional investor has a higher return than the typical retail investor, again, because adding that kind of higher return mix. But you're right, duration, longer, less liquidity. But again, if we're talking about retirement assets, I would think that investors would be happy to trade off things like longer duration and liquidity for much, much higher returns if this is capital that's already going to get locked up for a long time.
Eric, thanks a lot. Appreciate it.
Thank you.